Stop everything you're doing right now. Put down your coffee, close the door to your office, and silence every notification on your phone, because what I'm about to share with you is so significant, so earth-shattering for anyone holding precious metals or mining stocks that if you don't grasp this in the next 20 minutes, you could watch your portfolio get decimated while everyone else scrambles to understand what just happened. It's Saturday, January 31st, 2026. And while most people were enjoying their weekend completely oblivious to what transpired on Friday, the Canadian precious metals market just experienced its most violent collapse in over 4 decades. We're not talking about a minor correction here. We're talking about a systemic shock that has left even the most seasoned mining investors questioning everything they thought they knew about this market. Let me give you the numbers that are making veteran traders physically ill right now. According to data from goldprice.org, silver prices in Canada reached a staggering 116 Canadian dollars per ounce as of January 30th, 2026. But here's what they're not telling you in the mainstream media. Just a day earlier, silver had touched an all-time high of 165.2 Canadian dollars per ounce. That's a decline of 49.2 Canadian dollars, representing a catastrophic 29.78% drop in just one day. But those numbers only tell part of the story. When we zoom out and look at what happened on Friday, January 30th, in US dollar terms, silver experienced something not seen since March 1980. Silver futures plummeted a mind-blowing 31.4% in a single trading session, settling at $78.53 per ounce. Spot silver crashed over 37% at one point during the day, falling from over $120 down to around $84.63. Think about that for a moment. Over 37% of silver's value evaporated in less than 24 hours, and it wasn't just silver. Gold, which many thought was the ultimate safe haven, dropped like a stone. Gold prices fell more than 11% on Friday, settling at $4,745.10 per ounce after hitting nearly $5,600 earlier in January. This was gold's worst single-day crash since the 1980s, according to market data reported by CNBC and Bloomberg. Now, if you're sitting there thinking, okay, silver and gold crashed, but what does this mean for me? Let me tell you exactly what this means, especially if you're holding Canadian mining stocks. The Toronto Stock Exchange experienced absolute carnage on January 30th. According to the Canadian press and CTV News, the S&P TSX Composite Index plunged 1092.61 points in a single session, closing at 31923.52. To put that in perspective, the TSX lost over 3% of its value in one day, representing billions of dollars in market capitalization simply vanishing into thin air. The basic materials sector, which is heavily weighted with precious metals miners, led the bloodbath. And here's where it gets personal for anyone holding mining stocks. Pan American Silver Corporation, trading under the ticker PAS, got absolutely destroyed. The stock dropped from $63.29 to $54.60, a decline of 13.73% by the close. But during intraday trading, PAS was down as much as 20 to 25% according to multiple market reports from Yahoo Finance and industry sources. This is a company that had surged 188.76% over the previous year, and in just one session, a massive chunk of those gains evaporated. Wheaton Precious Metals, ticker WPM, one of the largest precious metals streaming companies in the world, fell between 4.9 and 6.8%. Franco-Nevada dropped by similar amounts. Barrick Gold, one of the world's largest gold producers, tumbled 12 to 15%. Agnico Eagle Mines fell over 10%. The VanEck Gold Miners ETF, ticker GDX, which tracks the overall performance of companies involved in gold mining, plunged as much as 13% before recovering slightly. The junior miners fared even worse. The VanEck Junior Gold Miners ETF, ticker GDXJ, crashed 15 to 18% at its lows. And before you start thinking this is just a one-day overreaction, let me pause right here. If you value original, deeply researched content and want to help push back against channels that just recycle the same information, hit that subscribe button right now. More importantly, if you're with me on this silver journey, if you believe in holding physical precious metals and understanding what's really happening in these markets, drop a comment saying, I am with GSI Silver Guy, so the algorithm knows you're serious about this content. Your engagement helps me continue bringing you these critical daily updates that you won't find anywhere else. Now let's get back to what's driving this absolute massacre in the mining sector. The catalyst for this entire meltdown came from Washington, D.C. On Friday, January 30th, 2026, President Donald Trump officially nominated Kevin Warsh to become the next chairman of the Federal Reserve, replacing Jerome Powell when his term expires in May. This announcement, detailed in a White House press release and immediately covered by Bloomberg at 1:45 p.m. Eastern Time, sent shockwaves through every corner of the financial markets. But who is Kevin Warsh, and why did his nomination trigger the worst precious metals crash in over 4 decades? Kevin Warsh, 55 years old, is a former Federal Reserve governor who served on the Fed board during the 2008 financial crisis. He has a reputation on Wall Street as a monetary policy hawk, someone who prioritizes fighting inflation even if it means keeping interest rates higher for longer and potentially slowing economic growth. Here's why this matters for precious metals and mining stocks. Throughout 2025, one of the primary drivers pushing gold and silver to record highs was what analysts call the dollar debasement trade. Investors worldwide, including major central banks in China, India, and Turkey, were buying massive amounts of gold and silver based on the fear that the U.S. Federal Reserve would keep interest rates low, print more money, and ultimately devalue the U.S. dollar. This fear was amplified by President Trump's repeated public criticism of Jerome Powell and his demands for lower interest rates. The market started pricing in a scenario where the Fed would lose its independence, become politically controlled, and engage in policies that would weaken the dollar. Precious metals thrive in that environment. When investors believe the dollar will weaken, they flock to gold and silver as stores of value. It's Economics 101, and that's exactly what we saw throughout 2025. According to market data, silver gained an astronomical 152 to 161% in 2025 alone, while gold climbed 66%. But Kevin Warsh's nomination completely flipped that narrative in an instant. The market interpreted Warsh's selection as a signal that the Federal Reserve will maintain its independence and possibly pursue even tighter monetary policy. Krishna Guha, vice chairman at Evercore ISI, stated in a note to clients, "The Warsh pick should help stabilize the dollar and reduce the asymmetric risk of deep extended dollar weakness by challenging debasement trades, which is also why gold and silver are sharply lower." The U.S. dollar index immediately rallied 0.8% on the news. Treasury yields spiked higher, and because gold and silver are non-yielding assets, meaning they don't pay interest or dividends, the sudden increase in interest rates made them less attractive to hold compared to bonds and other interest-bearing investments. This triggered what analysts are calling a technical liquidation event of historic proportions. Christopher Wong, a strategist at Overseas Chinese Banking Corporation, told reporters that this validates the cautionary tale of fast up, fast down. He noted that before the Fed chair nomination, metals were already primed for extreme moves as soaring prices and volatility had strained traders' risk models. According to a Goldman Sachs research note, there had been a record wave of purchases of call options on silver and gold, which mechanically reinforced upward price momentum. When the Warsh announcement hit, all of those positions started unwinding simultaneously. Matt Maley, equity strategist at Miller Tabak, described the scene as getting crazy. He stated, "Most of this is probably forced selling. This has been the hottest asset for day traders and other short-term traders recently, so there has been some leverage built up in silver. With the huge decline today, the margin calls went out." What he's describing is a margin call cascade. When traders use borrowed money or leverage to buy silver and gold, and those assets suddenly drop in value, their brokers demand they deposit more cash to cover their losses. If they can't come up with the cash, the broker automatically sells their positions, which pushes prices even lower, triggering more margin calls, creating a vicious downward spiral. This is exactly what unfolded on January 30th. Peter Schiff, CEO of Euro-Pacific Capital and a well-known gold advocate with over 1 million followers on X, posted that day, gold just had its worst single-day crash since 1980, plunging 5 to 8%. The catalyst is Trump's nomination of Hawk Kevin Warsh for Fed chair. Miners like gold and NIM are getting crushed. But here's where it gets interesting from a Canadian investor's perspective specifically. The Canadian dollar, which had been strengthening and reached 16-month highs around 1.35 per US dollar just days before, started to weaken as the US dollar rallied. According to trading economics and currency exchange data, the USD CAD exchange rate rose to 1.3556 on January 30th, up 0.48% from the previous session. This created a double whammy for Canadian precious metals investors. Not only were silver and gold prices collapsing in US dollar terms, but the strengthening US dollar versus the Canadian dollar meant that Canadians were getting hit even harder on a relative basis. Think about it this way. If you bought silver at $158 CAD per ounce last week, and now it's at 127 CAD, you're down nearly 20% in Canadian dollar terms. But if you were holding US dollar denominated silver futures or mining stocks traded in New York, your losses could be even more severe because of the currency movements. The TSX, which is heavily weighted toward natural resources and mining companies, bore the full brunt of this dual assault. Alan Small, senior investment advisor at IA Private Wealth, told reporters, Kevin Warsh is more hawkish than maybe some of the other candidates. That gave a bit of a boost to the US dollar and a sell-off for gold and some of the metals that act as a hedge against the US dollar. He added, "You're seeing metals retreat for the first time, and I'd say a meaningful retreat. That would probably be the main driver of the decline on the TSX today." Beyond just the big names like Pan American Silver and Wheaton Precious Metals, the carnage extended deep into junior mining stocks. These are smaller exploration and development companies that don't have the balance sheets or cash reserves to weather prolonged periods of lower metal prices. The reality is that junior miners operate on razor-thin margins. Many of them aren't even in production yet. They're exploration companies looking for the next big deposit, burning through cash every quarter, relying on investor enthusiasm and high metal prices to raise capital through stock offerings. When silver crashes 30+% in a day and the overall mining sector sees $20–30 billion in market cap wiped out, these junior companies face an existential crisis. Their ability to raise new capital evaporates. Projects get delayed or canceled. Jobs are lost, and investors holding these stocks can see 50, 60, even 70% of their capital disappear. Industry veterans at the Prospectors and Developers Association of Canada Conference and similar forums have been warning about this risk for months. The parabolic rise in silver and gold created euphoria in the junior mining sector. Companies that had been left for dead in 2022 and 2023 suddenly saw their stocks triple or quadruple. But now, that bubble has burst with extreme violence. Ole S. Hansen, head of commodity strategy at Saxo Bank, posted on X on January 30th, noting that gold turned sharply lower after the Warsh announcement. He had been one of many analysts warning that the precious metals rally was showing signs of overheating. So what happens next? That's the trillion-dollar question that everyone in the mining sector is trying to answer right now. There are several camps forming among analysts and industry experts. The first camp, represented by people like Peter Schiff, believes this is a short-term policy-induced shock that doesn't change the long-term fundamentals for gold and silver. Schiff argues that regardless of who chairs the Federal Reserve, the underlying structural issues driving precious metals demand remain intact. He points to massive government debt levels, with the U.S. government now carrying over $37 trillion in debt and running trillion-dollar deficits year after year. He also highlights the continued buying of gold by central banks worldwide, which has been happening for over a decade as countries like China, Russia, India, and Turkey diversify their reserves away from the U.S. dollar. According to the World Gold Council, central banks purchased record amounts of gold in 2024 and 2025, and there's no indication that trend is reversing. Schiff predicts that once the initial panic subsides, gold and silver will rebound, possibly even making new highs later in 2026. His reasoning is that Kevin Warsh, despite his hawkish reputation, will ultimately have to deal with the same economic realities that Jerome Powell faced. If the economy weakens, if unemployment rises, or if financial markets become unstable, even a hawk like Warsh will likely have to pivot toward lower rates. The second camp takes a more cautious view. These analysts, including teams at major investment banks like JP Morgan and Goldman Sachs, believe that precious metals are entering a consolidation phase that could last several months. They point out that silver's rise above $120 per ounce in January was driven more by speculative mania than by fundamental supply and demand. They note that silver has both monetary value as a precious metal and industrial uses in electronics, solar panels, and electric vehicles. If global economic growth slows due to higher interest rates, industrial demand for silver could weaken, putting additional downward pressure on prices. These analysts are looking for silver to find support around the 70-80 range in US dollar terms, which would translate to roughly $95–110 CAD. If it holds above those levels and consolidates through February and March, there's potential for another leg higher higher later in the year. But if it breaks below those support levels, we could be looking at a much deeper and longer correction, possibly back to 50-60 USD. For gold, the key technical level to watch is around $4,600 per ounce. That represents the 50-day exponential moving average, a closely watched indicator by technical traders. If gold can hold above that level, bulls remain in control. If it breaks below, we could see a test of $4,000 or even lower. The third camp, which includes more contrarian investors and value-focused money managers, sees this crash as a potential buying opportunity, but only for high-quality names with strong balance sheets, low debt, and diversified production. They're looking at companies like Wheaton Precious Metals, which operates a streaming model where it finances mines in exchange for the right to buy production at preset prices. This model is less capital-intensive and less risky than traditional mining operations. Even with a 6-7% drop on Friday, WPM has still generated over 100% returns for shareholders over the past year. Similarly, major producers like Newmont Corporation and Barrick Gold, which have massive scale, diverse asset bases, and fortress balance sheets, might offer value at these depressed levels. These companies can generate strong free cash flow even at lower gold prices, and they pay dividends to shareholders. The contrarians are avoiding the junior miners and exploration companies, at least for now, because those are the highest risk plays in a volatile environment. Now let's talk about what this means for the average Canadian investor watching this unfold. First, if you're holding physical silver or gold, the immediate question is whether to sell or hold. This depends entirely on your investment timeline and objectives. If you bought precious metals as a long-term store of value and inflation hedge, a short-term crash driven by Fed chair speculation shouldn't fundamentally change your thesis. Physical metals have no counterparty risk, they can't go bankrupt, and throughout human history, they've preserved wealth through various crises. However, if you bought at the top thinking prices would continue rising forever, or if you used leverage or borrowed money to buy metals, you need to seriously reassess your position. Leverage magnifies losses just as much as it magnifies gains, and if you can't stomach seeing your position down 30-40%, you probably shouldn't have been using leverage in the first place. Second, for those holding mining stocks, particularly Canadian-listed miners on the TSX, you need to do a company-by-company analysis. Look at their all-in sustaining costs, meaning what does it actually cost them to pull an ounce of gold or silver out of the ground, refine it, and sell it. If gold is at $4,700 and a company's all-in sustaining cost is $1,400, they're still printing money even at these lower prices. But if a junior miner's costs are $1,800 per ounce or higher and they're carrying significant debt, they could be in serious trouble if gold stays at current levels or goes lower. Third, understand that mining stocks are leverage plays on the underlying metal prices. A 10% move in gold or silver can translate to a 20-30% move in mining stocks, both up and down. This volatility is not for the faint of heart. It requires strong conviction, research, and the ability to think independently rather than following the crowd. Fourth, for those considering buying the dip, remember that catching a falling knife can be extremely dangerous. Just because a stock is down 40% from its high doesn't mean it can't fall another 40%. Wait for signs of stabilization, look for technical support levels holding, and most importantly, only invest capital you can afford to lose entirely. The precious metals market has always been subject to extreme volatility. We saw it in the 1970s with the Hunt brothers trying to corner the silver market. We saw it in 1980 when silver briefly touched $50 before crashing back to single digits. We saw it in 2011 when silver hit $48 and then spent the next decade in a bear market. This latest episode is just another chapter in that long, volatile history. What makes this situation particularly challenging is the intersection of monetary policy, geopolitical tensions, and speculative mania all colliding at once. The Kevin Warsh nomination wouldn't have caused such a violent reaction if precious metals hadn't already been stretched to extreme valuations. Similarly, the metals wouldn't have reached such extreme valuations without the underlying fears about dollar debasement and Fed independence. Looking ahead to the rest of 2026, there are several key events and data points that will determine where gold, silver, and mining stocks go from here. First, we need to see how Kevin Warsh actually performs during his Senate confirmation hearings, which will likely take place in March or April. If he comes across as pragmatic and data-dependent rather than ideologically hawkish, markets might give metals and miners a second look. Second, economic data will be crucial. If U.S. inflation stays elevated despite the Fed's previous rate hikes, Warsh will face immediate pressure to either raise rates further or hold them high for an extended period. Either scenario could keep pressure on precious metals. Conversely, if economic data weakens sharply, showing signs of recession, the Fed might be forced to cut rates even with Warsh at the helm, which would be bullish for metals. Third, geopolitical developments continue to be a wild card. The situation with Venezuela, tensions in the Middle East, ongoing trade disputes, and U.S. relations with China all have the potential to drive safe haven flows back into gold and silver. Fourth, central bank gold buying patterns bear watching. If major central banks continue accumulating gold at record rates, that represents structural demand that can support prices regardless of short-term trading dynamics. And fifth, the supply-side equation for both gold and silver remains tight. Despite higher prices, new mine production has been relatively flat because it takes years to develop new deposits. Permitting has become increasingly difficult in many jurisdictions, and ore grades have been declining at many existing mines. On the silver side specifically, the industrial demand story is real. The transition to electric vehicles, expansion of solar power, and growth in electronics all require silver. Some analysts estimate that green energy transition alone could consume hundreds of millions of ounces of silver annually by 2030. For Canadian investors specifically, there's an added dimension to consider. Canada is one of the world's top gold producers and a significant silver producer. The mining sector employs hundreds of thousands of Canadians directly and indirectly. It's a critical part of the economy, particularly in provinces like Ontario, Quebec, British Columbia, and the Northern Territories. When the TSX mining sector gets hammered like it did on January 30th, it's not just wealthy investors taking losses, it's retirement accounts, pension funds, and everyday Canadians who hold resource stocks as part of their portfolios. The Bank of Canada will be watching these developments closely as well. A strong commodity sector has traditionally been a pillar of Canadian economic strength. If mining companies start cutting capital expenditures, delaying projects, or laying off workers because metal prices have collapsed, that could have ripple effects throughout the Canadian economy. On Friday, Canadian GDP data showed flat output in November, with manufacturing continuing to contract. The Bank of Canada is already navigating a challenging environment with trade uncertainties, potential U.S. tariffs, and domestic economic weakness. A prolonged downturn in the mining sector would only add to those headwinds. As we wrap up this analysis, I want to bring everything full circle to where we started. What happened on January 30th, 2026 was not a normal market correction. It was a flash crash of historic proportions triggered by a single policy announcement that fundamentally shifted market expectations about the future path of U.S. monetary policy. Silver's 30+% single-day plunge, gold's worst drop since 1980, the TSX losing over 1,000 points, Pan American Silver getting crushed by double digits, and billions of dollars evaporating from mining stocks. All of this happened in the span of a few hours. This is the reality of investing in precious metals and mining stocks. They can deliver extraordinary returns when the stars align, as we saw throughout 2025, but they can also deliver extraordinary losses when sentiment shifts, as we saw on January 30th. The key question now is whether this represents a temporary setback in a longer-term bull market for precious metals, or whether it marks the beginning of a more prolonged correction that could last months or even years. The answer to that question will depend on Kevin Warsh's policies once he takes over the Fed, on how the global economy performs, on geopolitical developments, and on whether the structural drivers that pushed metals higher in the first place remain intact. One thing is certain, the world is watching, mining executives are watching, central banks are watching, and millions of investors who either made fortunes or lost fortunes on Friday are trying to figure out their next move. This is the kind of market environment that separates the professionals from the amateurs. It separates those who invest based on fundamentals and long-term conviction from those who chase momentum and trade on emotion. If you made it through this entire analysis, congratulations. You now have a comprehensive understanding of what happened, why it happened, and what it might mean going forward. You're better informed than 99% of people who are just reading headlines and panicking. Subscribe if you haven't already, and comment, "I am with GSI Silver Guy," if you're committed to following this story as it unfolds. I'll be here every day bringing you the latest updates, the deepest analysis, and the information you need to make informed decisions in these volatile markets. Remember, knowledge is power, especially in markets this chaotic. Stay informed, stay rational, and never invest more than you can afford to lose.